Hello, everyone, and thank you for joining us today for our Lunch with Lew webinar. My name is Jimmy Bassett, and I am a Senior Financial Advisor at Altfest. Today, Lew will be discussing his economic outlook for 2021 and what you can expect in the new year. After Lew's remarks, I will ask him a few selected questions that our clients have submitted. We expect today's call to last about 45 minutes. A recorded playback of this webinar will be available should you wish to listen to it again at a later time. And now it is my pleasure to introduce Lew Altfest.
Hi, everybody. I hope you're feeling better. Your spirits may be down, but your portfolio is up. Let's talk about where America is going. Well, let's talk about the psychology of the country. We'll discuss the outlook for the economy, stocks, bonds. Some interesting questions will follow. But first, I want to start for you with a story. Then you'll see the relationship. The story was when I was young, I had gone to see my uncle. My uncle was in a nursing home, and it was not a great nursing home with people making sounds, whatever. But I actually was, even though I was impacted by it, I actually was pretty optimistic. I felt pretty good. I had just gone to a diner with my father and my two brothers, and my father was ordering, and I noticed he had this great watch on. It was a 1930s Hamilton watch that was an Art Deco one and had black lettering and gold numbers. And I said, well, that's really nice to my father, who cared only about two things that were material, only to really. That was a good-looking car and a watch. And he said, well, you like it? And he just took it off his wrist and unstrapped it and gave it to me. So I felt good. So I went in there and talked to my uncle, and then another uncle came in with with an aunt. Now they came in at the same time, but they were not speaking to each other. They hadn't been speaking to each other for decades, and as a matter of fact, they argued. They'd come over in the same at the same time to the United States, and they argued as to which one was older. Now, that's something that I can't figure out why that should be, but it was. And I was just tempted to go over to them, and then I decided that I would. And I said to them, I remember the words. I said, "What are you doing? Why is it your blood relatives? Why can't you talk to each other? I bet you don't even remember why you argued to begin with." And I spent another minute or two discussing it. And lo and behold, they listened to what I had to say. And I could see the engines were running, starting to run. The engines of relationship were starting. And I remember that this in today's context because I think that Biden, I'm just a little pea compared to Biden. He's a ton better than most people I know, and he knows how to get people together. He knows how to appeal to their self-interest in a soft way, and he will do what's necessary to have that take place as the country goes forward. And I know someone who is fairly close to me who was raised raised alongside the Biden family, and have pictures of Joe with her just affectionately, whatever he was doing. And I asked her, is Joe what he really looks like? Is that the real Joe? And she said, yes, that is. And I don't see him just as having uh, that factor. He's also can express relationships. Besides relationships, he can implement. He can be tough. He can react. And as we're seeing now, he is coming on strong to begin with. So that's something that I'm going to use as a backdrop in what I'm giving you in our discussion. So uh, why don't we go over the economy? Let's start with that. The economy is kind of wacky now. It's wacky in the sense that it's supposedly very weak, but it isn't so weak in many areas. It isn't as bad as people make it out to be. Many people have a lot of money in their pockets. It may be hard to spend that money, but it's especially when you're staring at four walls, but uh, they will be able to do that. They are doing it, actually. Poorer people have difficulties. The affluent people don't have any difficulties. The poorer people who've had lower paying jobs in restaurants, hotels, vacation places. They're going to have they've had problems, and layoffs may not even have bottomed yet. So the poor have been hurt. Um, Washington's response is to help, and I have no doubt that we're going to have another aid package. Um, and outside of the dichotomy between the two, home purchases have been very strong in particular. That's going to help us. Um, the fact that the Democrats did well in Georgia and controlled the Senate is a big factor. The situation is very good. It's not going to be Bernie, who has positioned himself well as he's going to be the budget committee chairman, is going to have some power. But don't look for Bernie's program to get in. Bernie doesn't have, Biden doesn't have the votes for this program. Uh, the program of the left. And I'm not sure, I'm not even sure, I'm sure that that's not what he wants to do. He wants to govern down the center. He wants to appeal not only to people on his left, but he wants to appeal to people who are independents, which is going to be a real balancing act in which you dole out benefits to people to the right of you and to the left of you. The, the COVID vaccine is coming. People are anticipating the COVID vaccine. And as long as it comes, we're going to get perhaps not in the first quarter, maybe in the first quarter, but a slow to moderate pickup in the economy. But in the fourth quarter, things are really going to take effect because most of the people, as it turns out, will have the injections the vaccine, and if it gets postponed a quarter and it starts in the first quarter of 2021, that's okay too. The Federal Reserve is going to continue to be active. Infrastructure spending is on Biden's plate, but it's not going to happen right away. It will be put off to 2022. It can be trotted out earlier if the economy weakens. Therefore, this infrastructure spending will be a hedge against the decline in the economy, which is obviously a good thing. Well, let's talk about stocks and bonds. Domestic bond returns are likely to be very weak in general, as the Federal Reserve helps to keep rates low. Stocks, not on the other hand, while stocks are high relative to history, and I mean high, if we look at this chart that I made, it's a JP Morgan chart, it shows stocks over a period of time. The period of time is through the 90s and into the present. And what we see is stock valuations, PE ratios. Forget about, some of you know what PE ratios are, some of you don't. Just say the higher the PE, the higher the opinion people have of the market, the less room there is to grow for stocks to appreciate. Not the opposite. It isn't, when people are enthusiastic and they love stocks, that's good. It's actually, you're paying for their optimism. And you see in the 90s, a time to the year 2000, it's a behavioral time. It was a time when we were entering a new century, and that really grasped people. And they put that, for that and other reasons, they brought stocks up to a high that was inevitably not going to be sustained. And we see that stocks are high right now as we look on the right-hand side. Thank you, Jimmy, for that indication. All right, let's move to the second chart that I will give you. Those will be the only charts, so that's not your cup of tea. It's not coming any further. All right, so the second chart is, do we have the second chart? There we are, good. So the second chart is a chart of the green line, is the green and black line. The black line is all other stocks. The green line is valuations of the 10 most important stocks. You know, well, I'm going to get to that later about Tesla. I believe it's one of them now. You see how enormous the disparity is between regular stocks and these stocks. Many of these stocks today are technology companies, and these stocks represent the great valuations given to technology now. Now, unlike the valuations that were given to technology in the late 90s, the PEs, the valuations, that there weren't such great earnings at the time. Today, the technology have stronger backing, but they're very high. And while we have technology, where, as I'll discuss, where somewhere else in the part of the cycle, and we are putting emphasis elsewhere. Okay, and during this period, what we've seen is value, traditionally the way to make money, has been underperforming. And last year, as great as the S&P and technology did, value was actually close to being flat for the year. Now, how have we done during this period? How have we done? What's been our activity? Well, let's examine that. We were heavily in early 2000. We were heavily tilted toward downside protection. We were telling you that we didn't like the way markets were moving up, and we were steadily putting in hedges and keeping our accounts, our monies in conservative areas, and keeping our bonds as high quality bonds. And clearly that helped us because we protected your portfolio from a sudden market decline. For a typical account, there was a time when we were down almost half that of the market. So if the market were down 50%, you were down, including bonds, including other things. The market was down 30. There was a decline of 17% or something in the market. There are, of course, variations by account. Consumer and technology stocks in emerging markets benefited your portfolios. Increased technology exposure and investment in India and international value also helped us during this period. You have portfolios that are more diversified, including the investment in India. Although we've had investments, we had investments in India 10, 15 years ago, and got out of them and are now benefiting from having entered them has helped us. During the decline, we took positions. During this decline, we took positions in many securities. One area that we took a position in was mortgage-backed securities. Those are just bonds, mortgages of homes that are not guaranteed by the government. And that has worked out very well for us in the space of low rates. These bonds have considerably greater rates, and we still have them. We are maintaining high, as we go forward, we're maintaining a more conservative posture, but with some heavyweight investing. We are maintaining high inflation protection and bond allocations, and because I'm going to be talking to you about that and why later on. We also have money. We positioned during this period, putting money in cyclical stocks, which are more value oriented, and put really money into value oriented sectors in general. We initiated Alternative Alpha. Alternative Alpha is a short-term performance approach. That's where you're going to see some of this gunslinging in and out area. That's a modest to moderate part of your portfolio, but that by its ability to buy and sell in some extreme cases, I'll give you an example, buying on a Friday and selling on a Monday. It's not typical at all, but it's helped us, and even in alternative alpha, we keep them for longer periods than that. And the performance is actually up since we've initiated alternative alpha, has outperformed the market by 10% in most accounts, even though it has lower risk. That's like a magical thing. Outperform with lower risk. We'll hopefully be able to continue doing that. So consequently, your performance has been strong, even though you've had value funds in there that have lagged the overall market. So overall performance has been strong, and we still have a cautious position relative to the overall market, as you could see why from those charts. Going forward on what are we going to do in the future? What are some plans? Well, we have our in-house real estate partnership and the possibility of an additional equity offering with a different style of investing. I'd like to go over two thoughts on market factors now. The first is psychologically driven, and the second is about the role of interest rates. Let's talk about the behavioral approach. The people are stuck in their homes and they don't have enough to do. You may well be stuck in your home, as I and other people are. And being cooped up in house or apartment makes people antsy and depressed. So I spoke to my dentist about that, and she said that many more people are ordering what I call tooth guards to prevent damage to teeth because of grinding. Why are people grinding? I think you know. It's unconscious pressure because of the circumstances. All right, so what are people doing about this pressure? How are they relieving themselves? Well, many that used to play when they're younger or whatever, Monopoly, are now playing Monopoly with stocks, Monopoly with real money. They're putting money particularly in volatile technology and biotechnology issues. If a stock is lower priced, that's a good sign of crazy investing. The lower the stock price, the more interesting you are to people. So if you're once selling for $40 a share and you split the stock 10 for 1, now you sell for 4. You're the same company, just with many more shares, 10 times the number of shares, but to people, you're more appealing because you're selling cheaply. In other words, it's almost like brainless investing. The poster child in this regard is Tesla. Tesla's obviously a legitimate idea with a favorable outlook, but one in which car dealers would have to sell not only to the United States people, but the mermaids on planet Venus, there better be millions of mermaids on planet Venus to justify its current price. Uh, so that's a word of warning about speculation. Being manic among some about playing the market's going to change over time. Um, all right, let me go over the second item. This is an item I want you all to be careful to listen about because it's very important. And I'm going to make it. It's could be complicated. I'm going to attempt to make it simply, and I'm going to present some Broadway entertainment for you. And in the word of having Jimmy, a guy who himself is, as he's mentioned, is a senior financial advisor, he's going to ask me a few of the questions as I go forward that you might ask to make it more interesting for you. So you better do a good job, Jimmy.
Will do, though.
Okay, that's going with the flow. Okay, interest rates generally represent demand and supply for money. That's not so hard, you know. Demand and supply. That there's great demand. Well, I'll just mention it this way: interest rates rise when there is a great demand for money. And well,
I think that makes sense, Lou. Maybe a good question here is when does that happen? At what point is there a demand for money that would make interest rates rise?
okay. So you might have thought about that, and then that is when the economy is getting stronger. That's when there's greater demand. People want money. They want to invest money. They want to invest. Businesses want to invest money, and um, and I would say, but rates will be today. Well, I don't know. Speak up.
So, no, sure. So, kind of along those lines, you were talking before about that there were lots of parts of the economy that are still pretty strong now. So, would that then bring us to the conclusion that we'd be seeing interest rates rise now or very soon?
Yeah, we would be. We should be. But the Federal Reserve doesn't want to. Doesn't want to. They want to keep rates low right now.
And I guess the follow-up question there is, what's the thinking behind that? Why does the Federal Reserve want to keep rates low?
The Federal Reserve, low rates make it easier for businesses and households to borrow. And in this environment, that's what we're after.
All right, and that makes sense. So extending, I get that, and I understand interest rates obviously play a strong role in the bond market. How does that translate to the stock market?
Well, for for the majority of people, stocks and bonds compete with each other. They are both what we call liquid, that you can buy and sell them overnight uh, or the same day. And um, bonds and stocks different in the sense that bonds provide low risk investment with interest income, and stocks provide dividends, and the potential gains in price make them more volatile. When yields go up, this is key, bonds and stocks go down. When yields go up, bonds and stocks go down. Let me, all right.
That makes sense. I can see, for a bond, you have a higher yield, it can affect it. But how does that come in and play more directly with stocks?
Yeah, all right. I'm going to give you the bond and I'm going to give you the stock because the bond plays into the stock as you asked that. I'm going to give you an example. Assume that interest rates go up from 3 to 4% right away in one day, just hypothetically. You are the existing holder of a bond that provides 3% annually, but rates have now gone up to 4%. And you say, I just I just bought my bond at 3 and now it's 4%, but it's new. I just bought it today. Let me take my money out of the 3% bond and put it into the 4% bond. You can't do that. Who's going to buy your 3% bond when people are offered 4%? In order for you to sell that bond, your bond of 3% is going to have to go down so that it yields to a purchaser 4%. So you're not going to get your $1,000 back in a bond. That's how it's normally traded. It's going to come down to whatever it is, say $950. And then you can sell it. So now you see, people, why when interest rates rise, your own holdings don't benefit like you think because rates are higher. You lose when interest rates go up. And that this is likely to happen in bonds now. The outlook for bonds, you have to be very careful. Okay.
And then, Lew, is there a similar trade-off then there on the stock side as well?
Well, yes, because when bonds have gone down in price, they're no longer yielding in the marketplace 3%, they're yielding 4%. We just said that they're up, interest rates are up. They are now more competitive with stocks. People can say, God, I can sit back with 4% yield or an inflation adjusted 4% yield, and I don't have to worry about stocks declining. And so both stocks, existing holders for stocks and existing holders for bonds, lose when interest rates go up.
Okay, I guess so. Then that would lead to me, if we see interest rates going up and it's going to be bad for stocks or bad for bonds, why not sell now?
Well, let me get to that in 1 second. I'm going to say here, just to be dramatic, since we're in a Broadway, remember I'm giving this a Broadway act, here's a secret. It's so secret I'm going to whisper it to you. But you know what I'm going to say. Stocks are high right now. I've already explained it to you. It's true that people are willing to buy now because they believe the near-term outlook is good. One plausible scenario is the economy does well and COVID is contained and people begin to gorge on goods, buy goods, as they did after World War II. And there's a parallel between, the war that countries have and the war that we have now in and overcoming the pandemic. Consumption, now that things are over, consumption exceeds or on their way to being over, consumption exceeds expectations and prices of goods rise. Consumption exceeds, prices of goods go up, causing inflation. Inflation is like a disease. It must be put down. So the Federal Reserve starts to raise interest rates. Rates move up from 1% today to, say, 3%. People see the Fed means business about protecting against inflation. The rate rise makes bonds more competitive. Like mountain climbers without ropes to hold them, which is a real sport, by the way, investors begin to look down and wish for more safety from high stock prices, and the bet, big bad stock market moves in the other direction. It moves down. So now
I see.
your question is appropriate. Why not sell now? The near-term outlook is good. You can't know when the correction will come. Until it does, stocks could move higher. But we're more conservatively postured for that event. Unless economic growth and corporate profits really move up sharply, the ultimate correction is almost inevitable. Any sharp rise in interest rates could really hurt stocks. That's why I'm spending the time on this, so you understand that. Particularly if corporate profits don't move up strongly to offset it. If you have strong gains in corporate profits, then that the profit growth can offset the fact that valuations are so high and will be coming down. Another plus would be, and this one is likely to occur, a better trade environment with China. That doesn't make us all buddies, which Biden would be cognizant of the concerns about China nearer term, even though he himself has a buddy-buddy relationship with President Xi, who came over to this country, and I think Biden was his host. So they have something, and don't forget what I said about bringing people together, which Biden is particularly good at when these are people that can be useful to the United States, whether they're domestic or foreign people. So a better trade environment with China under and Biden will create a trade umbrella for the rest of the world, so that we should see trade, we should see these countries moving up around the world and helping to enrichen many countries, including the United States.
Thank you. No, I think that was great. I think right now at this time we'll move on to some of the questions that we've received. So at this point, I'll start with our first question. What are the risks in your scenario that can create a different outcome?
Okay, what are the risks in the markets? One is contrarian thinking, which we are contrarians to some extent. Things short term look good. Many times something externally happens that puts a hole in the balloon. Remember how many of you were so sure of a negative result last year, and the opposite happened? So you have to be careful when many people are manic. The exact opposite of what they expect can happen, and it's happened twice in the last 2 or 3 years, where the beginning of the year looked terrific and the rest of the year did not. All right, and the second I'm going to tell you is the COVID. The COVID might, as we see, is becoming more contagious, and we don't 100% know if the vaccines will work the same way on them. And just can I have a word of cynicism when I see 95% proof? I say, and everybody's competing with one another, maybe either through the contagious because it's more contagious, or maybe through other means, the 95% declines. If it declines modestly, like bringing it to 85, which might be something that I would anticipate, um, that's not so terrible. But if it brings it down and we see some other real difficulties, that could really hurt psychology and the environment. And lastly is expectations. The stock market sells based on expectations. Always remember that, because when you see a great earnings for a stock that isn't looking at, wasn't expected by the street earlier to have good earnings, but came in with good earnings, and then when they're announced, the good earnings, which are already been anticipated, the stock goes down. Good earnings results in the stock goes down, and you say, this is a wacky market. I think I'm going to stick to Las Vegas. At least I know that that's got no rationality to it. People don't know that stocks act crazy. Uh, Stocks really act rationally, and they anticipate. They don't wait for it to be printed in the New York Times. They move based on stocks move based on anticipation, and so people become afraid that after the surge that I've mentioned to you in the fourth quarter, first quarter, that things will be back to normal. That's going to be treated negatively and anticipated by the market. Of course, the market could continue to perform pretty well. But I'm giving you a negative scenario, the three negative scenarios that I see.
Thank you, Lou. We move on now to our next question. Why are you getting involved with operating private real estate?
Well, as I mentioned to you, I've mentioned to some of you, uh, and I've mentioned here, uh, bonds are a weak form of investment now. Stocks, as discussed, are high. In general, real estate can go up in an inflationary environment that we may well go into, not this minute, but go into. Stocks would go down, as I've mentioned. Bonds would go down. Stocks just temporarily, bonds permanently, and uh, real estate could continue to climb. So it's a good diversification tool. And real estate in general has a lower risk profile than stocks. That real estate housing goes up and down, but not nearly as much as uh, manic depressive stocks can do. All right, so we saw this as an area that had opportunity and that we could buy them according to our philosophy of value orientation. And for those people who are nervous about putting some money into private investments because their money is stuck there, in this case, we have an expected life of just 3 years for any investment, and we expect in year two to get a large amount of cash back to people. And if they want to stay with it, they can stay with it and buy the new investments that come in if these are successful. But they have been successful in our test market. I've invested with it, and I'm reinvesting my money and my profits to put it in, and or you can take the money out. So it isn't that long a period. And Andrew Altfest has had nearly 5 years of experience. And when he came to me, he said, um, "This is really good." And I said, "Yeah, why don't we do this for our clients?" So that's we feel this works out well. Um, Many of the old timers with our firm, we've had people who've been with our firm for 25 years or more. And some of the old timers may remember the 5 states oil and gas partnerships that we offered. That we didn't offer directly, but we offered through a firm that we really got to know very well. And that worked out very favorably. We believe potentially that we could do as well or better with this real estate.
Sounds great, Lou. Thank you. We'll go on now to our third question. This is a question I've heard a lot in a lot of different forms, but will income taxes go up?
Yeah, the income taxes are going up. A part of what Biden wants is a reallocation. He wants to, I believe, place more of the wealth in the hands of uh, people who are of more modest means, and he thinks that that will help to unify the country and benefit everybody in the country. So, but he's not going to tax everyone. He's just going to tax the high income people. He says 400,000. It might go down through negotiation with the Republicans, but it's not going to be for average investors. So it's going to go up. The businesses have had a very sharp decline in corporate profits, and they're going to go up as well. But they won't go back to where they were, but they will be going up. And it's going to be packaged, I believe, as a part of the economic revitalization program. And this is not going to happen right now. It's going to happen later on. He can't wait too much later because there's the risk of Republicans getting one or both houses in the midterm, and then it will be too late. So to me, it's likely to be a 2022 item.
Thank you. We'll go on to our fourth question. Does Altfest have an eye out for investment in renewable energy or any other aspect to keep our planet livable?
So this came from a very sharp woman who even put in some extra pizzazz into it by saying that Biden believes. So why shouldn't we put that money in something that could benefit all? Renewable energy's economics has gotten a lot better than it used to be. In fact, a likely price increase over time for oil will make renewable energy even more competitive as competition. It's really moved up. There have been some, as part of the greatness of the United States is the ability to focus on something and make it more efficient. And renewable energy has really, you could almost say surprisingly, been made more efficient. Unfortunately, right now, the prices for renewable energy are high, and it would be better if they were to decline some. On the other hand, this other investment that I've talked to you about potentially having, which would be more growthy with some smaller companies and invested in it, would be a very good place to put some of the more attractive items that help people with the quality of life in that portfolio. So we may be doing some more discussions for it before before too long.
Thank you, Lew. And then we'll do our last question. As an 82-year-old who is somewhat risk averse and with about 40% of investments currently in bonds, which you indicate have poor returns at this time, do you recommend a rebalancing of the portfolio or just leave it as is?
These are questions that I think this person who's 82 has been with us for I don't know how many years, like 25 years, asking sharp questions. And what should we say about that now? We need to continue to hold a portion of our investments in bonds for income and liquidity needs, although the income, we still are managing to get more income than the 1% that U.S. Treasuries have in many other areas. But now I'm telling you that we recommend that another portion be placed in real estate for diversification purposes for reasons that I've just discussed with you, including the potential for above average returns. And that's true even if you have some real estate exposure elsewhere. So we've already taken into account much of what we believe is the right balance between risk and return. And but we feel that this item, and one of the big reasons that we are high on this, is because of the benefits in this environment elsewhere. So that's how I would express it.
Thank you. No, that's great. Thank you again, Lew, and thank you everyone for joining us and for sending us your questions. In case you joined today's webinar late, or if you'd like to pass Lew's remarks along to a friend, we will be posting a replay of the webinar on our website, and we'll send you an email once the replay is available. And of course, if you have more personal questions, please contact one of the members of your wealth management team or call our office directly at 212-406-0850. Once again, thank you for joining Lunch with Lew, and have a nice day.